Okay, so I had a quick look at Zscaler or Zscaler. That's another one. So in this kind of like security kind of cybersecurity kind of bracket, this one grew revenue at 52% year on over year. So it's 387.6 million. This is their second quarter. Sorry. So billings grew 34% year over year to 493.8 billion. Deferred revenue is over a billion, grew 46% year on year. A GAAP net loss of 57.5 million compared to a GAAP net loss of 100.4 million on a year over year basis. So they've halved the losses essentially. Non-GAAP net income of 57.6 million if you want to sub off all the stock-based comp. So yeah, few interesting bits and pieces in here. So they generated about 90 million in cash, which is about 23% of what they brought in revenue. So pretty decent margin there. Free cash flow projection was to bring in another 62.8 million, which is another sort of 16% of revenue. Cash and cash equivalents of about 2 billion on the balance sheet at the moment, on a company that is worth at the moment 17 billion, so it's a 15 billion enterprise value. It looks a pretty interesting stock to me, Steve. I think it's coming down to a decent valuation. It's another one of those that's fallen massively off its highs. It's down about 52.41% just on the 1 year basis. Heavy spike in the middle where it got to 313 quid. It's down 61% from there. Market hated this, Steve, mainly because there was a few little bits in the report that were pretty bad. Billings only grew 34%, and these are going to suffer the same sort of problem that Okta is that basically the sales cycles for them are lengthening a little. There's not as much headcount, and they report that there's a lower deal close rate. So the guidance actually implied for about minus 9% in Q-on-Q billings, which is, not to worry if you think that, we're not going to go into a massive deep sort of tech recession. You think we're going to accelerate out of it, then this is probably just going to be maybe a blip. But yeah, I think billings is the reason it fell 12%. I don't think it's losing market share to any of its competitors. This is one of these that is directly in competition with Palo Alto, which is a big beast in the sector. Palo Alto obviously has a larger installed base of clients that it can kind of land and expand and upsell to, whereas Zscaler is still kind of, or Zscaler is still trying to do the landing. So it looked okay to me. If I would say, if this is going to be a blip, then I would say this might be one that you could pop on your radar. It's a really tough company to model because there isn't really any company in this space that's operating, showing operating leverage. So it's really difficult to figure out exactly what this would be able to churn out for you. But I mean, do you think this is a business that would be? I mean, we talked about Rightmove at the beginning, but do you think this is a company that could churn out Rightmove level margins eventually? I mean, even 50% would be incredible, but this doesn't seem, none of these cybersecurity businesses seem like something that needs millions and millions and millions of staff.
No, you mentioned it has a big competitor, namely Palo Alto. When I looked, it might be a few months ago now actually, Palo Alto shares looked quite cheap at one point. They looked like they'd had quite the fall for what I took to be an industry leader in this. This is high on my list of things that are kind of outside of my investable circle of competence. But when I think about this sort of thing, I sort of think, okay, what are margins going to look like? Clearly, cybersecurity is a growing space. Clearly, there's going to be some winners in this. The question is it going to be one of those things where everybody fights each other? And if it's just kind of them and Palo Alto in their particular part of the domain, that could work quite nicely. You would end up with something like a MasterCard Visa type thing. If it's going to be the case there's loads of different cybersecurity companies and stocks busy battling each other, then you probably end up with something a bit more like an airline, which is not so much with the operational leverage and the fuel costs and stuff, but the idea that everyone's busy fighting everybody to add incremental people, because if you have operating leverage going on, it doesn't cost you anything to go, or anything you make off another customer pretty much goes straight through to the bottom line. So you can kind of almost give it away. But that, I guess, is the kind of thing I haven't yet managed to patch together yet. I haven't quite worked out in this space. This is quite a basic thing. It's because I haven't tried hard enough. Work out who's competitor who's competing with who's competing with who, and who's competitor is what I was kind of after here.
Yeah, Palo Alto is definitely, you are right, is the big one in the sector. It's a 60 billion market cap at the moment, and it's actually the first time this quarter, because it had positive earnings this quarter, it's the first time I think it's ever had a PE ratio. So unfortunately there'll be quite a number of people who look at this and go, what's overvalued, because its PE ratio is currently 2,478, but obviously that is a fairly meaningless metric if you believe that at some point in the future Palo Alto is going to be able to slam its arm down on the table, a bit like Salesforce has done really, and said, here's what you could have won.
And there's a deep kind of truth to that, but there's also a sense of, I really don't care if people think that makes it overvalued. The more people there are saying that kind of thing, the better it's going to be for me, basically.
Absolutely.
I'm quite happy to go fish where people aren't fishing. I'm not sure Palo Alto specifically is where I want to be fishing, but the more people there are misjudging stocks by running them through kind of basic screeners and saying no all the time. I think a lot of investing is about saying no, and if it's what works for them, that's great, but it also is making my life that bit easier because other people aren't pushing prices up because they're not seeing something there that's maybe just one step further than popping some numbers into a table.
I feel like Palo Alto has the right kind of investors. It's one of those stocks that got really high during COVID, but is actually now only down about 7.5%. So it looks like it's got investors that are sort of thinking long term about this. I mean, it didn't rise as high as many of the others. It was up from peak to trough. He says not much. Only 231% looking at the chart, but it's stayed there as well, which is kind of testament to a good quality business.